The question we have to ask, John, is what local markets work for real estate investing?
Well, it depends on what you're doing.
Yeah.
Right? I mean, there's all kinds of ways to make money in real estate. You could be fixing and flipping. You could be doing multifamily, commercial, whatever. For what we do, we're focused on single-family homes. So for that strategy, I mean, there's really probably a handful of things that determine where we can play, right? Because again, we're looking for a 3-bedroom, 2-bath home, 1,500 square feet ish, prefer brick from a maintenance perspective, carport or garage in a B or C neighborhood. So we're not buying in the war zones, and we can't, quite frankly, we can't
buy in the A neighborhoods.
Can't buy in A neighborhoods. It's too expensive.
It's just too expensive. With the price to rent ratio just doesn't work.
That's right. Yeah. So it's the price to rent ratio. And I made some notes here, so I'm going to refer to those. And then, so price to rent ratio, you have to have the price to rent ratio, but you also have to have inventory.
Yeah.
Right?
You have distressed inventory.
You have to have distressed inventory.
Yeah.
And at a price point where that price to rent ratio makes sense. So that quickly narrows all the cities in America down to, let's say, about 31 of them. Places like Memphis and St. Louis and Indianapolis and Cleveland and Detroit, those types of areas.
Yeah, that's where we're doing deals, and like we live in Denver, but we're doing deals in those other areas with our local, our branch partners, our partners out there that boots on the ground or whatever. Because if we were trying to do, the model that we're doing, right now, and I'll let you explain it, wouldn't work here in Denver. Like the price to rent ratio just doesn't work. To buy an average rental property here in Denver is going to cost $500,000-$600,000. But you're only going to go get $2,000, $2,500 worth of rent out of it.
Right.
Where, give us an example of some of the deals we're doing in Memphis from a price and a rent perspective.
Yeah. So I would say the last probably 8 or 9 deals we've done, typically all in at right around 175. It's worth 200. And it rents for, $1,695.
Yeah.
So that 1% rule is people hear about.
Getting pretty close to that 1% rule. Whereas in Denver, you're at a 0.5 or even 0.4% rule. And so it's like that doesn't match the buy and hold strategy. So you got to match that market to your strategy. Right. Like if you're wanting to scrape and build, Denver's a great spot. We've done those deals in Sloan's Lake and all over Denver, Sloan's Lake, and up in Curtis Park and Berkeley and those kind of places here. That works just beautifully. But we're not trying to scrape and build. We're not trying to fix and flip. We're trying to buy and hold, right? That's what our investors are looking for.
Yep.
So markets like Memphis work. What else?
From a market perspective, St. Louis we've done deals in St. Louis. That's proven to be a good market for us.
San Antonio, we've started to get into that. We used to do that back in 2016, 17-ish. Yeah. The prices are a little higher in San Antonio than they are in Memphis, right? What do you think would be averages there?
I think for our model, probably 2 to 230, kind of in that range, all in, yeah.
What would it rent for?
It'd rent for, about $2,000.
About $2,000. So getting close to 1% rule.
It's not quite 1%, but I think we can get close.
Getting close. So then when we go out to these markets, we're seeing multiple markets, right?
Yeah.
What do you see as similarities? What's completely different? Like we talked about the difference in the prices. What do you see as the same? What are similarities?
Well, I think the similarities are there's a hefty portion of the population that rents.
Yeah. That's a good point.
That's our audience.
Well, remember when we were doing a data analysis on Memphis, and we were looking at how many houses were sold to owner occupants versus how many were sold to non-owner occupants, namely investors.
Investors, yeah.
I want to say it was, 50-50?
Yeah.
Or even more skewed towards the investors.
Yeah. There were 7-some thousand homes last year that were sold to investors.
And like 3,500 of them, exactly right. Yeah. So when we're talking about these types of markets, that's kind of stuff we're looking for, right? Being able to rent them.
Yep.
Here's what I've noticed, and you tell me if you've noticed the same thing. In every market in America, whether it's a market that we can do deals in or not do deals in, there's a part of town that the affluent people live. There's a part of town that the very non-affluent people live. And then there's everybody else, right?
Yeah.
I mean, we've gone to St. Louis and we went up to get some Italian food.
Oh yeah, on the hill. Yeah.
On the hill, yeah. I'll be in St. Louis in a couple weeks here. Went to Zia's. That was the name of the restaurant.
Great place. Great place.
I mean, describe going in there. What was Zia's like for you?
You walk in there and it looks like you're walking into a place that you're in Italy.
Yeah. Yeah.
You know, I mean, it's got that vibe and the staff and the food. I mean, just the whole atmosphere. Looks like you're sitting in Florence.
Like they've made the pasta. There's somebody there that showed up in the morning. And so you go into like, this is great. And then you go into some parts of St. Louis that, you almost got to shoot your way in and cut your way out. Like it's rough, right?
North City, St. Louis is not for the faint of heart.
Yeah, North City, St. Louis. So like when we're looking at these markets, it's kind of a science, but it's also an art, right?
Yeah.
Like we do the data analysis, just like you explained. Price to rent ratio, distressed inventory, average sale, days on market, all that kind of stuff.
Yeah.
But you can't just make a decision on a market that way, can you?
No, you can't. You got to get your eyes on it. You do all the prep you want, right? So that you think you're focusing on the places that would make sense based on our model. Mm-hmm. But at the end of the day, until you get in the car and you start driving them and really getting a feel for the neighborhoods, you don't really know.
When you're getting the feel for those neighborhoods, what are some key indicators that you're looking for? What are some things that just stand out to you to determine? We use the ABC model, A, B, C, D,
right.
F. Help me understand, and for our moguls listening out there, help me understand how the subjectivity comes in, what we're looking for to help with those gradings.
Well, I think there's a few things. One is if I'm driving a neighborhood, so I've done my data analysis, and I think, okay, I think this neighborhood is going to be a good fit for us. When I get there, I'm looking for all kinds of rundown cars and abandoned cars or flat tires or just the level of the cars, the level of upkeep in the neighborhood in general, people taking care of their yards. Yeah. Is there trash everywhere?
Right.
Are there people at 1 o'clock in the afternoon? Are they, drinking beer on their front porch? Are there people wandering around instead of being at work?
Yeah, so those are indications of like D and even F type neighborhoods.
Yeah, depending. I mean, F's are pretty obvious, right? I mean, there's nothing. There's no commerce.
It's been ghettoed.
It's ghetto.
It's been abandoned.
There's empty lots, abandoned houses. I mean, it's pretty obvious.
There's no shops going on there.
You're right.
There's a handful of things you can like. It's been abandoned. Yeah, that's how we define an F neighborhood.
Right. Now, and like, for example, Denver, it doesn't have an F neighborhood. And quite frankly, Wichita is one of the markets we went to.
Right.
That doesn't have an F neighborhood, in my opinion.
I agree with you.
So,
I completely agree.
So, but going back to your question, which what do we look for, right? So that's looking at the yards and people and this and that, but there's also the commerce around it, which you just alluded to. In our neighborhoods, BC neighborhood, you're going to have some brand names along with some mom and pops, but you're not going to have the boarded up strip mall. You're not going to have the old car wash that's tagged.
Vandalized and tagged.
Tagged. And, so you're not going to have that kind of stuff in the areas we want to be.
And so some of the indicators, we've kind of hacked it, and you made this observation, was the brand name commerce, kind of the chain type. If you go anywhere and you see a Starbucks, you're not in a D or F neighborhood.
Right.
You know that you're in now you could be in an A neighborhood, right? Because you're like, there's way more homeowners there. There's not very many tenants there. The price to rent ratio is out of the world, even if you are in a town like Memphis. But some of those other indications are like commerce. So what kind of commerce are you looking for, just more specifically, in B neighborhoods and in C neighborhoods that you just don't see in D and F neighborhoods?
Well, I think you hit it. It's the Starbucks of the world. I mean, think about it. The Starbucks or a Target.
Yeah.
I mean, they spend a lot of money doing analysis on the population, the area, the demographics, all that stuff. Why not leverage what they've already done? They've spent millions on it. They're pros at it, right?
That's a great point.
So might as well leverage the work they've done.
Thanks for watching. Hit the subscribe button right now. You don't want to miss the next episode. Every week, we drop practical money strategies and real stories that'll change the way you think about wealth.